Hello and welcome to Money Sense. I am your host, Emil Kalinowski, and I am joined by Simon Cottery. Our guest is Robert Tate, founder and investment coordinator of Global Rational Capital, a local Cayman investment fund focused on global equities and long-term capital growth. Our guest joins us in studio as we broadcast from the studio of Radio Cayman 89.9 in Grand Cayman and 91.9 on Cayman Brac and Little Cayman. Robert, welcome to Money Sense.
Thank you for having me on your show.
Absolutely. It sounds like you've got an amazing job. How did you get to this point? How did you become the founder of your own investment fund?
Well, actually, I became interested in investing at quite an early age when my grandpa told me about the power of compounding interest and how you can make money work for you instead of work for it. So I figured, well, I need to learn a bit more about this. So I decided, let me try the accounting route. So I started chartered accounting designation through Deloitte in South Africa, moved to Cayman, auditing funds, audited funds in New York as well, then started doing fund administration for UBS, then started working in the investment management industry at OAM, and then just under 2 years ago started my own firm called Global Rational Capital.
And what are you focusing on? What are you investing in? Most people, when they think of the market and investments, they think of equities, but there are bonds, currencies, commodities. What's your focus?
So the fund that I manage actually has quite a wide mandate, but we focus on equities globally. So I spend a lot of time traveling to various countries. Like for last year, for example, I went to Hong Kong, mainland China, Japan, Australia, New Zealand, South Africa, the US, meeting with several companies, management, also having calls over the phone, trying to understand their businesses, focusing on high-quality businesses that I can get an understanding of and hopefully purchase shares in at a price that makes sense for the fund.
And we're going to talk about all of that, but I'm really impressed with the fact that you're traveling and visiting these places because, at least in my mind, as I'm just thinking of myself, I don't know about you, Simon, but if I invest in companies, I will invest in them by looking at them on a computer screen and reading a news article and then investing in them, maybe. That seems not very methodical, but you're going and meeting people. That's very impressive. But so when you go and you talk to management, how do you know? You're there, you see the business, and how do you know if it's a good one? How do you know if management's telling you the truth?
Yeah, so, I mean, just on your first part, looking for businesses by focusing on businesses where you admire the product or you use the service is usually a good starting point. It doesn't end there because, a great business is a good starting point. It's not necessarily a good investment. It depends on the price you have to pay. But visiting countries and experiencing the culture and seeing what people are purchasing is important, especially in places that really are quite different to our culture, like in certain parts of Asia, for example. It would be quite dangerous to invest in certain parts of Asia where you have really no understanding of the culture and what people really like, or whether the business even exists, which is sometimes the case in places like China, where there is instances where businesses are there on paper but not actually there.
That's no exaggeration. I'm sorry to jump in, but my mom has a friend, and her son and neighbor, but it was just her son, invested in a business in China, and it was fully staffed, operational when they visited. But when they left, all those people turned out to have been actors hired, and it was just a scam.
Yeah.
So you're not exaggerating. That really does happen around the world.
Yeah, and wherever possible, I try as far as possible to experience the product. So, for example, when I went to China and I met with JD.com, for example, which is kind of like Amazon. It's sort of like an Amazon FedEx all in one, in the sense that they have a vast distribution system, which they sell as a service as well. But I met with them, but then I also decided, you know what, I want to actually use their service and see how it is. So I actually ordered a camera from JD.com here in Cayman, and there's no import duties on cameras, so I got it delivered. It took a while, but I got it, so that gave me a bit of comfort. But just going back to your actual question and meeting with management, and how do you know what they're telling, whether what they're telling you is the truth or not? It's actually is quite challenging. I mean, really, it comes down to experience and having as many meetings as possible. Then you get to you get a feel for it. I mean, you're not always going to get it right. But generally speaking, management don't have a huge incentive or to exaggerate, because it will come out in the numbers in the next couple of years or quarters. So they'll it's not really beneficial for them to exaggerate. But some companies do tend to exaggerate more than others, and in some countries I've also found that as well. Like lately, I've actually been finding that a little bit in some South African companies. Mm-hmm. Yeah, you got to sort of read between the lines. I think focus on the adjectives. If they're using a lot of adjectives, it's usually they're probably exaggerating a little bit.
Interesting.
But yeah, you still need to look at the numbers, right? You need to study the financial statements, and if things don't look right, you need to ask them about that.
A hot topic in finance that has been around for perhaps 5 or 6 years now is behavioural finance and the psychology of humans and how they behave in certain respects. Do you do any study in that area when you meet management? Do you do any training yourself in the psychology of humans as to tricks you should look for when they're speaking to you, as to whether those are truthful statements or not, as the case may be?
Yeah, the emotional element of investing is hugely important. It's probably the most important thing, actually. And one needs to be able to control your own emotions, because the market will almost inevitably move against you at some point. And you need to be confident that your investment thesis is correct and the rest of the market is wrong. And that's quite a big statement to make. So it's no wonder that most people become afraid when the market does move against them, because the market is many thousands of people and you're just one person, and you're making a statement that you're right and the rest of the market is wrong. So if your investment research is sound and solid, that will give you a bit more confidence to hold on. In terms of the emotional side, from the company's perspective, I look for an alignment of interest where management is on my side and they're not just out there, just to get a paycheck. So, for example, if management has a reasonable size investment in the company that they're managing, that's a good sign. Also, if they've started to purchase shares recently, that's also a good sign, particularly in companies that are of a cyclical nature, because the worst time to buy a cyclical company is at the top of the cycle, and the best time is obviously at the bottom of the cycle. But that's very difficult to determine. But management generally has a good understanding of the industry, and so when they start purchasing shares in their own company, it's usually quite a strong signal.
And I just want to delve a little bit deeper into that, because a lot of people listening to this will be thinking share buybacks. And you're specifically saying when management use their own money, not using the company money. Is that what I'm hearing you saying, or are you conflating the two?
Yes, so when management are using their own money to purchase shares in the company, they are giving a signal that they are confident in their company. It also depends on the amount that they're investing relative to their net worth. I mean, if it's a very small portion, then it doesn't count as much. Also, sometimes what can be interesting is if employees sort of lower down in the company's hierarchy are purchasing shares, that is also quite a strong signal as well, not just the top management. Yeah.
I think this helps explain why my stock picking is so poor, is because I'm not as methodical as you are. I'm not visiting these companies. And I read your most recent statement, fact sheet, and it said that your goal is to review 400 financial statements a year. Is that correct?
Yes, and 100 companies, meet with 100 companies a year. And yeah, I'm on target to reach that.
Hang on, there's 365 days in a year, aren't there?
Amazing.
How thick is each financial statement? These are doorstoppers normally, aren't they? They're 60, 100 pages.
Well, there's also quarterly financials, and there are certain things that you can look out for without having to read the entire thing. Okay. So one needs to be very selective of how you spend your time. Some prospectuses, for example, are like over 1,000 pages long, and
Well, that was an interesting point you made there. A lot of people, when they think about investing, they think, goodness me, there's so much information. How on earth do I focus on what's really important? And you've just said, actually, there are things that you should be looking out for that are more important than other things in a 1,000-page document. Can you help the listeners try to understand some of the elements that you think are the most important areas they should be focusing their time if or when they go through this process?
Right. Well, firstly, I'd just like to say for individual investors, it is quite time-consuming to invest in individual stocks. And so, generally speaking, I advise that most investors look at exchange-traded funds where they can get exposure to the market as a whole at a very low cost, because exchange-traded funds are automated, and so their costs are very low, and you get good diversification. But if one was to spend a lot of time and effort to invest in individual stocks, then some of the things that one would look out for in the financial statements is just the amount of debt, for example, net debt, so cash less the debt, the earning power of the business, how consistent earnings are, and the growth rate of earnings. So as a rough guide, a company that is growing at, say, 15% per annum, you could be prepared to pay, say, between 18 to 22 times earnings for that, depending on where the company is, how stable that and how solid that earnings growth is, and what sort of the interest rate environment is. But in terms of the financial statements, the other thing that one would need to focus on would really depend on the company itself. So if it's a banking stock, you need to look at net interest rate margins, capital ratios, provisions, etc. So it depends on the industry, and so the more companies you look at, the better.
Now, we only have a couple of minutes left before we go to break, so just give us a shorter answer, Rob. But for people who wanted to pursue this line of business but don't have the time to travel around the world and read 400 different annual reports, can you name a few books that would serve as a foundation for them to start understanding the entire investment research process? Were there any books, authors, individuals that helped you set your foundation?
Yeah, so generally I read books by investors who have really good investment track records. So I don't generally read books by people that don't have track records. And obviously, Warren Buffett is well known for being probably the best investor of the modern age. So while Warren has not written an actual book, he has written a lot of newsletters, so those are really good. Also, books by Peter Lynch, who has a similar investment track record to Warren Buffett, over 13 years, relative to Warren Buffett's 13 years at Buffett Partnership. So Peter Lynch's books. And then Benjamin Graham, who was the mentor to Warren Buffett. His books, The Intelligent Investor, was described by Warren Buffett as the best book he had ever read. And he said that he felt that when he was 18, and he still thinks that today. So I think that's probably a good book to read.
And that's a classic. That's from the 1930s. Isn't that right?
That's correct, yeah. It was used as the foundation for the CFA curriculum.
Was it?
Yeah, and chapters 8 and chapters 20 are probably the most important. They are on Mr. Margin and, Mr. Market and the margin of safety are the two most important concepts in that book.
Well, we're going to take a commercial break now, but when we come back, we're going to ask Rob to kind of give us a more methodical framework on how he approaches his stock selections, and maybe we as an audience can imitate that in some way.
One Trade X knows there's more than one way to invest. One Trade X is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. One Trade X has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at OneTradeX.com. One Trade X, the Cayman Islands' #1 choice for online brokerage. One Trade X is licensed to conduct securities investment business by the Cayman Islands Monetary Authority.
The only personal finance radio show in the Cayman Islands, hosted by Simon Caudry from the CFA Society Cayman Islands.
This is Money Sense.
Welcome back, everyone. We are joined by Robert Tate, the founder and investment coordinator of Global Rational Capital. And before we left off, we set kind of an intro into how we, perhaps as non-professionals, can start our investment process or imitating what Rob has done successfully. And he mentioned several books. Rob, in your latest fact sheet, you give 5 different equity categories that you look at. And I think it may be helpful for our audience to break down this broad universe of stocks. Can you talk about those 5 different categories and anything interesting in any one of those 5?
Sure. So previously I mentioned some of the books that I admire, enjoyed reading, and one of those was P. Lynch's books. And so these investment categories I actually borrow from his books. And since he has such a incredible investment track record, and he explains his process so well, I decided to make use of some of his approaches to investing, as well as a combination of his, Warren Buffett's, and Benjamin Graham's approaches to investing. So the 5 categories that I look at are fast growers, stalwarts, cyclicals, turnarounds, and asset plays. So fast grower is basically just, as the name implies, a company that's growing quickly, generally a medium-sized company, and it has the room to grow. And the key there is really not to overpay for the business. Clearly, you need to have a good understanding of the business, but generally, companies that are growing quickly become expensive quite quickly.
Can I clarify when you say fast growing? Because I think a lot of people over the last 20 years have invested in fast growing companies and seen the internet boom and then bust, and then you see the are you talking about fast growing in sales or fast growing in earnings, or a combination of what?
Earnings.
Okay.
Yeah, fast growing in earnings. And actually quite a good place to look for a fast growing business that you can buy at a reasonable price is actually not in a fast-growing industry, because a fast-growing industry is going to attract a lot of attention from 2 perspectives. From within the industry itself, and so you're going to have a lot of competitors. But then also, if you're looking at it from a stock market perspective, you're going to have a lot of investors sort of attracted to that sort of industry. So sort of hot industries, maybe say cannabis in Canada, for example, there's a lot of attention there. I prefer to look at industries where they're a little more boring. So, for example, I had a meeting with a company in the UK recently called Restore, and basically what they do is they store documents. It's difficult for me to think of something that could be more boring than that, and which is great because it doesn't attract a lot of attention. But this company has been growing at an exceptional rate over the last 8 years or so, and they've just been taking market share from other companies in the industry, and it doesn't make sense to store documents in London where the cost per square foot is so high. So they have warehouses outside of London, and they take the documents there and they store them there, and that's all they do. And then they just... It's a very sticky business, so people generally don't move from one provider to the other, and they just continue to take market share. And now they were a very small player, and now they're number 2 in the industry. And the business has actually changed now. It was a fast grower, but they've got to a point where they're actually so big they can't grow so fast anymore. So that's one thing you need to look out for in a fast grow, because when a company stops growing fast, then it re-ranks to a different category of investment, and its price-to-earnings ratio will adjust quickly. And you can get hurt if you do not sell your investment in a fast grower before it becomes a slower grower. And that's actually quite hard to read. So that is probably the biggest danger with the fast grower, is not seeing the slowdown in the growth and also paying too much in the first place.
I want to keep pursuing this angle of those 5 different categories, but you just raised a great question or point, and that is knowing when to sell. We're always talking about buying things when we are investing, but it's a 2-step process. When do you sell? This sounds like it should be an entire other show, but can you give us some rules, or do the rules change?
The rules depend on the categories,
Okay.
So I'll try to be quick if possible, but it like I said, it depends on the category. So for a fast grower, you probably want to sell, obviously when the company starts not growing as fast, and particularly when the price to earnings has not adjusted to your expected slowdown in growth that you envision for the business. Also, with a fast grower, you can hold on for longer as long as the business is continuing to grow fast. For example, when Walmart first started, like people thought, "Wow, this is great," and it was growing for so fast for 10 years, and people were like, "Wow, this is great," but it can't keep on growing for that fast for so long. And so a lot of people sold, but they made a mistake because it continued growing so fast for many, many years after that. The same could be said for Amazon. And the funny thing is about Amazon and Peter Lynch, whose investing model I like, is that he actually mentioned Amazon in his forward to the updated version of his book in something like the early 2000s. And he said, there's this company I really like. That you can buy some stuff online, and it's called Amazon. So you can read that. I mean, he's making the call.
Right.
At that time, it's really phenomenal.
But when you say Amazon, so everyone will be familiar with Amazon who's listening, and then you did earlier on say that you must look at companies who are growing earnings quickly. Amazon's earnings are sporadic often, depending on whether they want to report earnings or not, depending on whether they're investing a sufficient amount of capital to grow their business. So how do you assess something like Amazon, which has sporadic earnings but has very strong top-line sales growth? How do you make that assessment and the judgment as to whether that's a fast-growing company in genuine terms, or whether it's just overinflating itself in sales terms but actually not incapable of generating any actual earnings ever? Yeah.
So in that case, again, one needs to understand the business, and it's more than, in this case, than just using Amazon's website, because Amazon has other divisions as well that one needs to understand. One can make an estimate of, if Amazon was to choose to start taking earnings, what sort of margins could they achieve? And you could look at other players in the industry, perhaps elsewhere in the world even. Again, you're making assumptions there, it's more difficult analyzing a company like that, where you have to make quite big judgment calls, as opposed to a company that is already generating earnings. You don't need to make as big judgment calls. For example, if you were to try to get a feel for what sort of margins may be appropriate, I mentioned you could look at companies elsewhere, like, for example, Mercado Libre in Latin America is in a similar industry, and they're making very healthy profits. Alibaba as well. JD.com that I mentioned earlier, their margins are much lower, but they're sort of taking more of a growth approach as well, trying to build up their distribution as a service business model. So they reinvest a lot, and their earnings look less attractive. So it depends. It depends on what the company's growth strategy is. How much cash they're generating is also very important. You asked me earlier about when to sell, and I really only just touched on one category.
Go on.
But like stalwarts, for example, there are companies that are very large businesses, stable, have very solid competitive advantages and barriers to entry, where they can last for a long time. And because they're so big, you generally want to sell them when price comes up to intrinsic value. Fast growers, you can hold on for a long time because the intrinsic value you can expect to grow over time, where stalwarts, because they're so big, intrinsic value probably is not going to grow as much. Cyclicals, you generally sell when the cycle has turned. Can
you give an example of a difference between a stalwart and a cyclical? Because I'm conflating the two.
Right. So a stalwart would be a company, say, like Disney, for example. Mm-hmm. It has a solid brand. It is well known throughout the world. It also has some very attractive growth opportunities in terms of their content they have that they could put online, and which they are going to put online and compete. in that space. But they're a good business with a lot of brands, not just Disney itself. I mean, they got ESPN, Pixar, Lucasfilms,
and a Star
National
Wars theme park.
Geographic, Star Wars theme park, exactly. Yeah, when they take that content and put it online for easy access, I think that's a pretty interesting revenue stream that they're going to have. And when you compare that with a cyclical, well, a cyclical has a lot of exposure to the specific industry cycle. So, oil and gas companies, for example. I invested in an offshore drilling company in Norway last year that did well, and that was for reasons had nothing to do with the cycle. It was a rights issue in that case. But cyclical companies can be very dangerous to invest in if you invest at the top of the cycle. And in fact, earnings will look good at the top of the cycle. And you might be enticed because, oh, wow, the company might look cheap because the price-earnings ratio is low. But really, it's one needs to understand the cycle. And as I mentioned before, a good way of doing that is talking with management and talking with a few companies in the industry to get a feel for the industry and the cycle.
Now, Rob, I'm going to be the bearer of bad news for all the listeners because you've mentioned a number of companies during the process of this conversation, and someone's got to come out with some legal words of warning to people. And I just want to make the comment that, Rob, you've discussed a number of companies, but everyone should know by now, when we do discuss individual companies, we are not necessarily recommending them to each individual listener. And I say that because what you, Rob, invest in for your company may not be suitable for each and every one of our listeners. Each listener must listen eagerly, deliberate earnestly, and hopefully learn from what we've talked about. But please also make sure you do your own research before you invest your own money, and make sure that things that you invest in, you can afford to invest in if they go south. Because when things go bad, as Rob's mentioned, they can go bad very quickly. And if you can't dedicate a lot of time to them, you may not be able to get out of them quickly enough to afford to be able to stop losing too much money. So that's my health and wealth warning for all the listeners, and I apologise for bringing that up, but I thought it was important to do so.
Yes. Very important. Rob, we have no time left, and that's exactly when I love posing impossible questions to you. Just as final seconds, how can an individual become a successful stock picker?
I think by reading some of those books that I mentioned earlier, particularly books by investors that have a solid investment track record, one honestly really needs to spend a lot of time and effort on it. And if you're not going to do that, and if you don't feel that you have the emotional willpower to overcome the concepts of greed and fear, and you're not willing to put the time and effort into it, then I would generally recommend investing in exchange-traded funds that track indices and give you a wide diversification.
Robert Tate, founder and investment coordinator of Global Rational Capital, thank you very much for joining us.
Thank you.
You just listened to Money Sense, and you can re-listen on the CFA Society Cayman Islands webpage, and you can send us show ideas at moneysense@cndw.ky and via Twitter at MoneySenseRadio. Thank you very much to our sponsors, and thank you very much, audience, for listening. Thank you, Simon, for joining me today, and we will see you all back in a fortnight with a new episode of Money Sense.
One Trade X knows there's more than one way to invest. One Trade X is the Cayman Islands' only fully licensed online broker-dealer, offering discount trading services to individual investors and traders, hedge fund managers, and family offices. One Trade X has the most competitive online trading prices of any offshore broker worldwide, with no custody or management fees, free demonstration accounts, and no charge to open an account with a $5,000 minimum deposit. Trade stocks, options, futures, bonds, and Forex. Learn more and open your free demo account today at OneTradeX.com. One Trade X, the Cayman Islands' #1 choice for online brokerage. One Trade X is licensed to conduct securities investment business by the Cayman Islands Monetary Authority. Money Sense is brought to you with the support of One Trade X. One Trade X, the Cayman Islands' #1 choice for online brokerage.